If you want an exposure to a market or an
Everything they need in one place.
Being the world's foremost authority on individuals, advisors and institutions.
Hello and welcome to Morningstar. I'm Emma Wall and I'm joined by Tom Idzarek, Head of Investment Methodology for Morningstar. Hello, Tom.
Hi.
So we're here today to talk about popularity premium or unpopularity premium. You've written this fantastic paper with Roger Ibbotson. What's the theory behind it?
Well, I think there's a lot of theory behind it, and it's kind of hard to explain it relatively quick. But of course, I came from Ibbotson Associates, which is a firm that was acquired by Morningstar back in 2006. Ibbotson Associates was actually founded back in 1977. Roger did a lot of work on detailing the historical returns of stocks, bonds, bills, and inflation. And what you see, of course, is that stocks are riskier than bonds, and they've outperformed bonds. Say long-term bonds are more risky than short-term bonds or cash, and they've outperformed as well. And so, generally speaking, higher returns have come with higher risk, and this is well documented. And I'd say this kind of view of the world is syncs very nicely with kind of modern portfolio theory, the CAPM, a rational view of how the markets should behave.
Absolutely. Emerging markets, small caps, we all think risk equals return.
Right. And of course, it's very visible and for a large number of asset classes, that relationship holds. But then, you can point out that there's a number of other anomalies, whether it's the low vol, the low beta, value beats growth. There's these items that seem to produce a premium, but don't necessarily come with more risk. And so over the years, Roger and I have been engaged in conversations about kind of why does that occur. And if I go back, it's almost 10 years now, where we coined the kind of the idea of popularity, but we hadn't really sewn it up into a framework. And so we were thinking, well, is there a nice, simple, intuitive explanation that helps explain not only those premiums that come with more risk, but what about those anomalies, those premiums that don't seem to be associated with greater risk? And it was through those conversations that we began to develop, let's say, the unifying theory of popularity. And so what's so attractive about it is it does simultaneously do a good job of explaining both.
And it's very similar to sort of the concept of contrarian investing, isn't it? It's the opposite of what you want in high school. You do not want popular assets. You want to look for the unpopular ones.
Well, of course, in high school, I was hoping to be more popular than I was, but that wasn't the case. But of course, anything that's popular is often valued, let's say, by other students, or in this case, we're talking about stocks that have the most desirable characteristics. Well, the world has usually recognized that they already have the most desirable characteristics, and as such, their prices have been usually bid up. And so if you think about, risk is bad, so often, people avoid risky assets, and so that helps explain, people want to avoid risk, but stocks seem to move up. If you think about value versus growth, for example, value stocks are the stocks that have been, beaten down by the market. They're unpopular. They're out of favor with investors. Now, some portion of those value stocks will improve, let's say, whatever it is that they're doing, and as they improve, they will move up in price. So they will. The market will let's say, recognize that this deep value stock, as it might be, is improving their operations, and with it, a price increase occurs. At the opposite end of the spectrum, if you're talking about growth items, they're usually the items that are most in the news. They're glamorous. They have very high price to earnings ratios. They've been bid up, and some of them will fall. And you can apply the same concept to other things like size. So small cap tends to outperform large cap. By definition, I would argue that large cap is extremely popular. If you think about each dollar or pound or euro as a vote, large caps have a lot of votes behind them. Small cap don't. And some number of small caps will become large caps, and some portion of large caps will become small caps. So there's just this natural re-ranking. Whether we're talking about movies or hairstyles or fashion, you can almost always rank things around a dimension of popularity, and then there's this natural reordering or re-ranking that will occur.
And how, as the investor, do we sort what is just cheap and what is unpopular?
Well, cheap and unpopular may often be the same thing, and I would say that one question is like if cheap, how do you avoid like a value trap,
Absolutely.
for example? Yeah. And that depends on how you kind of try to take advantage of this movement from the unpopular state to the popular state. So for, let's say, a dimension of popularity, one is liquidity. So illiquid is less liked, and highly liquid is dear or expensive, and so people bid that up. As a stock improves its characteristics, it will likely become more liquid, and of course it'll rise in value.
Tom, thank you very much.
Hey, thank you.
This is Emma Wall for Morningstar. Thank you for watching.